Welcome. My name is Marcy Hampton, and I'm a faculty member of the UCF Dixon School of Accounting. In this short lecture, I am going to talk about the cash flow statement, and especially how to make adjustments in the indirect method. Remember, there are two formats for preparing the cash flow statement. There's the direct method and the indirect method. When we look at the difference between the direct and the indirect method, remember that the difference is only in the operating activities section. In the direct method, we show cash came in from here. Cash went out to here. We show the different places cash came in from. We show the different places the cash went out to, ending with the cash provided or used by the operating activities. In the indirect method, however, we start with net income from the income statement. We then make adjustments, adding and subtracting, in order to change net income into the amount of cash flow. Again, ending with the cash provided or used by operating activities. Regardless of whether you use the direct method or the indirect method, the ending cash provided from operating activities will always be exactly the same. So now we need to look at how do we actually make adjustments to the net income in the indirect method. We will cover this since most people do the indirect method. We take the adjustments and we break them into three different types of adjustments. The first adjustment is to remove any non-cash expenses from net income that went into calculating net income. For example, depreciation expense and amortization expense. Remember, for the journal entry, we debited the expense and we credited the accumulated account, neither of which is cash. But we had an expense, therefore it affected net income. Since it did not affect cash flow, we need to remove its effect from net income in order to have cash provided from operating activities. So, since we subtracted depreciation expense and amortization expense, then our adjustment would be to add them back. The second type of adjustment has to do with removing non-operating things from the net income that went into calculating net income. For example, if we had the loss from the sale of a long-term asset, this is not an operating activity, but rather this is an investing activity. But didn't it go into calculating net income? Absolutely. So if we want to change net income into the cash provided only from operating activities, then we need to remove the effect of any losses or any gains that came from the sale of long-term assets. Since the losses from the sale of long-term assets, if we had it, would have reduced net income, our adjustment would be to add it back. Likewise, if we had any gains from the sale of long-term assets, to remove their effect, since we added those to get to net income, we would now subtract them in order to remove their effect. The third and last type of adjustment are adjustments that we make for any changes in the balances in current asset and current liability accounts. For example, like accounts receivable or accounts payable. If you think about what happened, if you booked additional revenue and then you increased the amount of accounts receivable you had, you adjusted your net income, you increased your net income, but you didn't change your cash. So we need to adjust that for any change in the balance. Likewise with accounts payable. If we booked additional expense, we didn't pay it, instead we increased our accounts payable, neither one of those is cash, but it did affect net income. Sometimes it's a little tricky to figure out what direction do we make that adjustment. So what we're really going to find is that the direction of the adjustment that we have to make for any change in the balances for current assets or current liability accounts is going to depend on which side of the equation they are on. So here's an easy way to see how to make the adjustment and what direction to make it in. We're going to do it in relation to the accounting equation. Remember that we have to keep the accounting equation in balance at all times. So what you want to look at is, what adjustment do we have to make to cash in order to keep the equation in balance? Well, if we have a current asset account that the balance increased in, what would you have to do to cash in order to keep the accounting equation in balance? Since both are assets, both are on the same side of the equation, what happens to the current asset account? You would now have to do the opposite to the cash account to keep the equation in balance. So we would have to decrease cash. There's the direction of your adjustment. Likewise, if your current asset balance, like your accounts receivable balance, went down from the last period, what would you have to do to cash in order to keep the equation in balance? You would have to increase cash. So there's an opposite type of relationship here. Likewise, when we have current liabilities like accounts payable, if the balance has increased since the last period in the current liability account, what would you have to do to cash to keep the equation in balance? Since liability is on the right side of the equation, cash is on the left side. In order to keep it in balance, you have to do the same thing to both sides. So if current liabilities went up, then you have to increase cash. There's the direction of your adjustment, so you would add it. Likewise, if the balance in your current liabilities account went down, what would you have to do to cash to keep the equation in balance? You would have to decrease it. Notice that what you do to the cash here is the actual direction of the adjustment you're going to make when you're doing the indirect method in order to correct for any differences in current asset and current liability balances. And that's our tutorial on adjustments and the cash flow statement.